Hey guys, we've been in a crazy market these past couple of weeks, and one of the sectors nobody ever thought would go up is oil and gas. And I know, I've also sold oil and gas in the past, and never would have thought to hold it to this day. But when war breaks out, there's some crazy things that happen in the market, and right now it makes sense that oil and gas were surging. Although today when I'm filming this video, there was a major pullback in that sector. But looking at this heat map over the past month, the only bright green spot is energy and oil. So clearly in the past month, still a lot of these stocks or the entire market is oversold compared to the oil and gas sector. Today, we just saw investors come in, pile into the market in those oversold names, and a lot of these stocks were actually the high growth tech stocks people bought back into. Those are the ones that we saw the largest gains out there. For me and my portfolio, Nuve was the biggest winner there, going up by about 13% midday when I checked. Now, does this mean the bleeding is over for high growth stocks? I don't think that we're going to go back to the previous all-time highs just because of this one-day reversal. Typically, these market trends happen over a longer period of time. And just a one-day spike is usually people just buying the dip, or those short-term traders trying to make a quick buck and they'll sell off in the next week or so. I think these higher growth names over the long term, maybe the next year or two, they're not going to see too much price action like we saw in 2020 and 2021. We probably will see some crazy green days, but they're going to be few and far between, just like today. So if you're a long-term investor, don't get FOMO right now and just jump in because everything is going green. The best way to play the long-term investing game is to pretty much do what I'm doing, dollar cost averaging into your stocks. I think this is the one surefire way that you can guarantee or at least increase your odds of having a portfolio that grows over the long term. And when we're looking at my portfolio just in a few seconds here, you'll notice over the past year or so, my portfolio is still down. Right now I'm down about 5%. That's because I was buying heavily, or I guess a lot of my buying was done when the market was nearing all-time highs. It's kind of obvious that my portfolio would be in the red, and especially a decent amount of my portfolio is in high growth stocks. Not the entire thing like my other portfolio, but about 20 to 30% of them are in high growth stocks, and these names are fairly risky. But that's just what I set up for myself, that I'm okay and comfortable investing in these higher risk stocks, knowing that in the long term, it could pay off. I'm not expecting in the short term that I'm going to see some crazy gains. In fact, I was prepared for losses. And ultimately, it's just looking at the business model and having faith that management can continue to grow that business. And when the revenue grows and the money comes in, then the stock price will eventually follow. And as long as these companies are in the right industries and they have the right growth trajectories, then I'm happy with the stocks that I bought. So an example here is Shopify. And a lot of you guys know that I bought Shopify and kept buying fractional shares pretty much every single week. But ever since I started buying Shopify, it was sitting around the $1,700 to $1,900 mark. And today it's dropped all the way down to about $750. So yeah, I've lost more than 50% on those initial investments. However, I do believe in Shopify for the long term, and I really like the business model that they have. It's a very lean business model and it scales very well. And because their business model is fairly lean, they can compensate their employees a little better and get better talent that way. Now, if there's a Silicon Valley in Canada, Shopify would essentially be the Amazon of that Silicon Valley. And Shopify, when compared to Amazon, they're still a very small player. Amazon takes up the majority of the e-commerce market, making up to around 50% of that. Whereas Shopify, I think they've only penetrated around 5 to maybe 7% of the entire e-commerce market in North America. So there's still a lot of growth ahead of it. And although the stock has dropped by about 50%, if they capture maybe 10, 15, or even 20% of the market, then their stock price, I'm sure, will follow after, and I'll be laughing by that time. For those of you guys who have never heard of EQ Bank, right now they're offering 2.05% on the 3-month and 6-month GICs. If you go out to a year for the GICs, it's 2.1%. I personally put my emergency funds in EQ Bank because they're high interest savings accounts, and I've been buying these GICs, which have an even higher interest rate. Typically, their accounts offer about a 1.25 interest rate recently. That may change over time, but if you were to buy their GICs for 3 to 6 months, it used to be 1.35%. I'm not sure how long this deal is going to be around, but you can check out my link down below to sign up for EQ Bank today. Now, with all that pep talk about what's going on in the market, let's jump over to my portfolio and see what's going on there. Unfortunately, my portfolio, I'm down by 5.47% right now. But as I stated at the beginning of this challenge, my goal is to hold these positions for at least 3 to 5 years, and this challenge is going to go on for about 3 years. I'm trying to grow this portfolio to $50,000, and right now things are looking a little bit bleak, but with the markets, things can always change. So here you can see my holdings and how they're split, fairly even amongst all my positions. In terms of sector weighting, my technology sector and financial sector, those two are the largest in my portfolio, sitting at around 20% each. Next, we've got the indexes, and when I'm buying the index, it's usually because I'm not really sure where the market is going. Typically, the reason why I buy the index is because I see a dip in the index, or the other reason is I think that the stocks that I'm in right now have a little bit more to fall in the coming weeks. So I just buy the general index to try to keep up with the market, and when those stocks have finally sort of plateaued at the bottom, then I continue to buy individual stocks. So my index portion over the past half year has actually grown a fair amount. It used to be a very small portion of my portfolio, but now it makes up 10% of the portfolio pretty much. Now I'm highlighting all the transactions that have happened since my previous update. I've had 4 deposits of $200, and I've been buying Sun Life, Nuvei, National Bank, Shopify, some REI, VFV, and Power Corporation of Canada. I've had a number of Sun Life transactions in the past couple of weeks, and that's because Sun Life has actually come down from its all-time highs. And looking at the stats of the stock, right now the P ratio is sitting at 10. It's fairly decently priced in my opinion. It's got a dividend yield of close to 4%. My mom actually works for Sun Life, and I have a little bit of insider information there in terms of just what their bonuses are like. I know in 2020, they didn't really get very good bonuses. However, for the year of 2021, they got paid out pretty nice bonuses, meaning that the company did very well in 2021. So I think going forwards in 2022 with the economy recovering and I guess people just kind of getting back to normal life, I think Sun Life will continue to do well over the long term. You can also see that I've still been buying Shopify at around 863, 682. So I'm going to continue averaging into this position as the stock continues to fall. And I think that right now, if you don't have a position in Shopify, heavily consider if you want to start entering it. And Shopify already has a P ratio, 25.71, although I don't think that's correct, but they are positive on their net income. And they do have positive cash flow, meaning that the business is doing very well. I mean, the stock price did get ahead of itself when it was sitting at around $2,000, according to a lot of investors, but you can see that it's kind of fallen back down in line with the general trend that we've seen in the past 5 to 6 years. If you just kind of follow this line, we're kind of in line with that pattern right now. And this is just sort of a typical thing of the market where you see a reversion to the mean, meaning that the general trend line is there. However, investors got a little bit ahead of themselves right up here, and we're just reverting back to the mean. Now looking at the overall portfolio, you can see on Shopify, my percentage returns, I'm down close to 50%. Luckily, I've been able to reduce my cost per share down just recently when I'm buying at these very low prices. So I'll continue to do that, and hopefully one day Shopify will recover. Actually, I have no doubt in my mind that it will. Now here's a funny thing. TELUS Corporation is actually my biggest winner in my portfolio. And I would have never saw this coming. I'm up 23% on this position. The last time that I bought TELUS, let me just scroll over here, it was at 31.41. So this is maybe about a month ago. So in a month, TELUS has already gone up by about $2 per share, and that's around 7%. But if we look at TELUS in the past 5 years, you can see there was not much movement up until 2021. And then now we're seeing TELUS take off. And this could be because of 5G, and people are anticipating that 5G will bring in a lot more new business. This is probably largely because more devices will be connected to the internet and need cell service. And that's where TELUS is going to see an increase of revenue. Because right now, they're not going to see an increase in revenue because of the cell phone market, because that's pretty much saturated. But we're seeing a lot more IoT devices that need cellular network, and that's where TELUS is going to see its growth. If we look at the entire chart of TELUS, there really isn't much movement since 1999. I mean, the stock has tripled since then, going from $10 to $33, but over a span of 22 years, that's not much growth in my opinion. But where it shines really is its dividend yield. Now we can't factor in the dividend yield since 1999, but I'm sure if we factor that in and reinvested all those dividends, we probably see at least a 5 or 6x on this stock. And I think right now we're probably entering an inflection point in TELUS. So this is purely my speculation. I think that TELUS could be chugging a little bit higher, maybe to around $40 per share. But when it reaches that point, then I think we might see it fall back down and have another reversion to the mean and probably rest somewhere around like the $33 to $35 mark. Now, don't invest in TELUS because of my speculation there. That's just purely what I'm thinking could happen. And I think that you guys should form your own opinion on this, but that's just where I think things are going for TELUS. Be sure to subscribe down below because I'm going to have a stock analysis coming out for you guys very soon. I'm going to be analyzing the company Aritzia. And I think that it presents some pretty good value right now, but let me tell you why in that future video. So just go down there right now and hit that subscribe button. I've got a couple of videos up on the screen for you guys to check out. If you're there, I'll see you there. If not, keep up the grind and have a great day.